Have you ever wondered how to identify if a candle is about to break out or if it's just a liquidity grab to fake out essentially and go the other direction? This is a common mistake I see, and there's a lot of time in the markets where you want to trade a breakout, but that just ends up being a liquidity grab and you end up losing the trade. This is a very common mistake. And in this video, I'm going to teach you guys how to identify the difference between a breakout candle and a liquidity grab candle. And that's my goal, to help you guys differentiate between a liquidity grab and a breakout candle. So without further ado, let's get straight onto the charts and explain how it's done. So first thing is, what is a liquidity candle and what is basically a breakout candle? How do we differentiate them and what do we expect? So essentially, simply made, a liquidity candle is basically a candle that you expect to continue in one direction but leaves a wick and closes back essentially in a range, or is just grabbing liquidity from a certain zone because it's not continuing, right? So what we normally see is we see a candle with a bottom wick, which is liquidity grab. And let's say you were looking for sells, but then the next candle continues up and you're like, oh, why did that continue up? Because this was not a breakout. It was just breaking the zone to grab essentially more liquidity, or just, you know, some juice to give you the move towards the upside here, right? Whereas a breakout candle, we expect the continuation here, right? We expect price to continue in the direction that we see price essentially break. And there's a key factor that I'm going to explain in the video, which is going to help you differentiate them very, very easily. It's not going to be something complicated, right? So let's get into the three key things that are going to help you avoid getting caught in a liquidity grab and end up catching proper breakouts, right? So as always, guys, if you are enjoying my content and do enjoy these type of videos, please consider subscribing. We are also live streaming, so you can join that as well and ask me questions. Down below is some groups. I advise you to join these groups, because if you want to improve in trading, you have to ask questions, and that's the place to ask. It's not some BS group trying to sell something. It's a genuine place where you can ask questions. My Instagram's linked below. I'm posting content on there about trading, updating you and everything, so be sure to follow that. All of that YouTube BS are out of the way, and you know, hit the like and all of that. Let's get back into the video. And yeah, so let's have a look here at two examples as to where we can see price as a liquidity grab and where we can see price as a breakout, and then kind of explain to you what is going on the chart. So the number one thing is to avoid being caught out in liquidity grabs is going to be following the trend. When you seem to counter trend is when you will see liquidity grabs to the opposite side. Say we're looking for sells on the day and we see price start to push up, all right? You can start to make an argument, oh, price is pushing up, it closed above the zone, I can possibly look for buys. But when the higher time frame and the session bias, right? So I have plenty of videos of how to define session bias. You can also learn more on the streams of what we're looking for in a session. But when the session bias, let's say, is bearish and you're there looking for potential buys just because you see price close up above a zone, you're going to likely be caught out in a liquidity grab, because all price is doing is pulling back to continue the move down. And we see a clean example here on the charts. So we see price here try to breach above this zone here. We can see how it barely closes above, looks like it was creating support, boom, wicks towards the upside. Everyone thinks it's a breakout, start to take buys, especially on the 30-minute here. As you can see, closes cleanly above the 30-minute resistance. We see this candle, boom, everyone starts to take buys, expecting it to fill this zone, but the trend has been bearish here. We've been going towards the downside. We get this fake out back into the range and it continues down, right? I would say, could you sell from up here? Yes, you could sell from up here. It's a little bit early for me. I'd prefer this 30-minute close below this zone here, which would give you more confidence, because this is breaking structure. This hasn't broke structure yet, so you could get rejections any time, but that's a different story. That's more about price action trading. But this information here, we keep safe out of the move, and that's why if we're looking to trade outside of the zone, we want support above the zone before continuing if we're looking to counter trend this, right? So this is where you will get caught in a liquidity grab here, is when you're not trading with the trend, all right? You can see that happen many times before, and that's why preferably you needed to break the wick. So this brings me on to my second point here, is just a wick breaking a zone is not a breakout here, right? So if we have a wick breaking a key zone here, that does not count as a breakout. You can't expect continuation after just the wick. A breakout is normally done by a candle's closing above, but not a 1 minute candle here. No, we're talking about at least a 15, a 30, or a good few 5 minutes closing above that zone, which would normally equate to a 15 anyways. That is what's going to give you that move, and that's what's going to give you the breakout of the zone. So wicks are not breakouts, they're just a break of the zone. You have to identify the difference between breakout and break of the zone, right? And that's where a lot of people fail, is they don't understand breakout and break of the zone, right? So a break of a zone is simply when the wick breaks the zone. A breakout is when we get a closure and then the continuation. So if you're following trend, you can expect a breakout to continue. So you can find a zone for a breakout. We can see here, like this, for example, here we get the breakout of the zone, price closes above, it goes and reaches the next target around this resistance here, and eventually taps the main target up here, right? So this is a breakout. Why? We got the closure above the zone. This closed deep, the next candle respected the zone, and this is what I mean respecting the zone here. This was not a liquidity grab because we didn't just leave a wick. The liquidity grab was done to the downside, and you can see here even a smaller liquidity grab. So if we know we can potentially be bullish from this, and this is where your higher time frame knowledge and stuff comes from here, you can see how potentially this is your zone for a breakout. Okay, so you're looking for closures above here, right? And we can see what happens here is we get a liquidity grab. So taking sells here is not a good idea because you're selling into a zone that you've seen many rejections and liquidity grabs. And with higher time frame knowledge, you could expect some more upside from here, right? So we can see price liquidity grabs. How do we know that? Is because price did not close below the range. There's no continuation. If price did not close below, then there's no continuation, and this is where you guys get caught out. You start seeing it break the zone and you start to try take entries. This is wrong. What we need is a closure. So this ends up, so once we see this gives us the advantage to say, oh, okay, this zone is being respected, it's being rejected, and we can see some upside. We get this closure here, which is the first bullish closure that's telling us, okay, next watch point is what are we going to do at this resistance? Are we going to get the fake out back in like we did back up here? Or are we going to hold support above the range in order for us to continue this move? So we see the candle close above. Everyone takes buys here typically, but on the breakout candle, which is fine. You can take it, but it's not as advanced entry. And especially if you're holding stops here, guess what happens? Boom. Your stop, you're saying, oh, look what happened. No, this closed very deep outside the zone. You are trying to trade something that's very, very closing. You're trying to trade something that's already gone essentially, right? You're buying too high. So what you need to see is some structure. We can see we get a nice pullback here. This candle here does what? Does not close back in the zone. And this ends up being kind of your liquidity to give this move towards the upside here, right? So essentially what I'm saying is in order to catch breakouts, you need the candle closures. Once the candle closes above the zone, it creates new information and allows you to take moves towards the upside. So if we go back and have a look at some more examples here, here's a very clean example here like this. We can rewind to here and see what ends up happening, right? So we can see here that essentially we had this range here, right? The range is defined by like this. We were respecting. Now all of these times that price tried to wick below, but did not close below is where you would have failed, right? So we're looking for close below this support here, right? This is your zone here, below the support here. Every time that price did not close below is when you guys are getting caught out, right? You think, oh, bearish candle close here. No, it did not close below the zone. Bearish candle close, did not close. You have to be patient. If price just drove down here, did this, so what? It's not in your plan. You don't want to be caught out in these wick moves, right? But what we can see here is price keeps rejecting the highs. We're not up here. We have this bearish move down, but we're failing to break back up. We're just kind of ranging sideways. So nothing really changes on the chart, right? But when we start to break down here and get the actual close below, and notice what the last candle does, right, with this wick. When we get the close below, what ends up happening here? You can see that the close gives us the breakout, and we have the breakout of our zone. And once we have the close on the 15, what can you expect? You can expect price to break down here. And what do we get to fill this LTA towards the left? We can see we get the breakdown, right? So that is how you identify a breakout versus a liquidity grab here. And that's the key important point, and it's as simple as that. So to wrap up the thoughts, so you guys can have all the thoughts simply wrapped up, is number one, follow the trend. You're most likely going to get caught out in liquidity grabs when you're trying to counter trend. If you're going to counter trend, you have to wait for support. Number two is wait for closures. I can't express how important it is to wait for closures. Don't wait for price just to wick in and out of a zone, you have to wait for closures above and below a zone. And the last thing is trade during volume times, because when there's volume, you're more likely going to get the breakout instead of the fake out. And that's the saying, right? Times of volume, you're more likely about to get the breakout than the fake out if you wait for closures, right? So that is basically it. That's all I want to cover. It's pretty simple here, and I hope you guys enjoyed this video and found something useful. If you did, please share it, do whatever you can. Let's get this up, let's run it up. And with that being said, take care, trade sharp, and until next time, peace.